Personal Finance Practice Problem using Excel. Personal Financial Statements Part 2, the Income Statement on a Cash Basis. Prepare to get financially fit by practicing personal finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're down here in the Practice tab as opposed to the Example tab. The Example tab, in essence, being an answer key. Information's on the left-hand side. We're going to populate that into the blue area, into the income statement on the right-hand side. In the prior presentation, we looked at our data on the left, color-coded it for assets, liabilities, or income and expenses, talked a bit about where we might get that information, and then we constructed this beautiful, colorful balance sheet. The bottom line of it being the net worth. The net worth, now we're looking at the income statement, which is kind of like the story about how we got to the balance sheet. So you can think about the income statement kind of feeding in to the net worth, which is our assets minus liabilities, but only going 1 month back to give us a bit of that story. So to do that, let's go back up top. Let's hide some cells. We're going to put our cursor on column D and left click. I'm going to drag all the way over to column G. I want to select this entire space so that we can hide it, putting our income statement right next to our data. So we're going to right click on it. We're going to hide that information. So now we've got our data on the left, income statement on the right. Now I'm calling this an income statement, although it's going to be on a cash basis. So you might just call it like a cash flow basis. Note that when we're kind of putting this stuff together, it depends how you're constructing your income statement or what you're using it for, meaning you might just put like an income statement together periodically for whatever your needs are for budgeting, or if you need to get a loan or something like that, or you might be doing your bookkeeping, in which case you might be using a double entry accounting type of system, recording the transactions as you go. Also note that we're on a cash basis versus an accrual basis. Those two things are not completely different, however, meaning even though we're on a cash basis, there are going to be some accrual components, some things that will complicate the system that we have to make a decision about as to whether it would be worthwhile to deviate from a cash basis to an accrual basis on them. I'll try to point that out. This kind of causes problems, and a lot of people, get a little frustrated with those types of things as to why you would do that. And, we want things to be really cut and dry between cash and accrual, and it's kind of not in reality. So let's first go through here. We only have two categories for our income statement. We've got the income or cash inflow, and then the expenses or cash outflow. That's nice, those two main categories. We could have other subcategories if we so choose. I'll try to mention some of those as we go. But in essence, the income statement is inflows minus outflows if you're looking at cash, or simply income minus expenses. Then, however, the expense category is going to be one of the longer categories that we have. As we look at the expense categories, note that they will differ from our standardized expense categories, or more standardized that we might see on the business side of things, as our personal objectives will differ from the business objectives. So that's where some of the big variations or differences between personal and business will happen. You have to think about your own customization for your own personal goals, whatever you are using the income statement for. If you're using it for budgeting and you want to use it to help you budgeting, say with even things like diet or whatnot, then you might break out, for example, restaurant expenses between fast food and sit down and groceries, or even types of food that are being purchased or something like that, which is something you would not do on the business side of things, because on the business side of things, the only objective is revenue generation, and that's your goal. Where on this side, you might have different kind of objectives. Okay. So first, let's have our cash inflows. That's going to be our starting point. Cash inflows, which could be called just income or revenue line item. I'm going to put a colon for that line item. We're going to imagine we only have one income source here, that being our wages. We're going to imagine W-2 wages here. Note that on the revenue side of things, cash inflow, typically will have a lot less accounts involved, although we hope that the dollar amount will be greater than the expenses, because when we work, we specialize in the thing that we can make money in generally, and then we spend all our money on all the other stuff that we want, right? So that means there's going to be a lot more categories with regards to expenses, but hopefully the dollar amount will be less than the dollar amount on the income. So we're going to have the income, I'm going to call it monthly take-home pay. Note that we're recording this as take-home pay, and if you look at your paycheck stub, this is one of the first confusing item. If you look at your paycheck stub, you clearly have gross pay minus what they took from you out of your paycheck, which includes at least taxes, which would generally be in the U.S. Social Security, Medicare, and federal income taxes. And then they might take out benefits, for example, healthcare possibly, and retirement plan. So note that you could kind of think about this as two kind of cash flows that are happening. One, you're getting the gross wages, and then two, you're paying the outflow, whatever expenses, which include the payroll taxes. So you could record this net, meaning the full amount here, and then the payroll taxes that they took out down below. Also note that if they took out money for something like a retirement plan, that falls into one of our confusing categories, because although it's a cash outflow here, money's going out, then you can think of it as an outflow because it's coming out of your paycheck, out of your checking account, but it's going into an asset, right? It's not being spent or consumed. It's going into something on the balance sheet. So when you're recording that on a recording day-by-day transaction, then it should basically be increasing, the balance sheet side of things. So in this case, we're going to keep it simple and just record the net pay. And I'm going to bring that into the inner column. Even though there's only one category, we could put it in the outer column just from the start. But I'm going to keep this double kind of thing to keep our convention of having an indentation and then pulling the total in the outside. So that's going to give us our total. We're going to say total cash inflows or income and brackets. And so I'm going to indent this, selecting this, home tab, alignment, indent. We're going to bring this to the outside. We'll say this equals that 4007, underline it, font group and underline. Indent this again, home tab, alignment, indent. We'll make this that dark blue color, like that color right there, by going to the font group, the bucket, making that dark blue. Is that the one? That's not the one. It's over here. That's the one I used, I think. That one. Okay. Is that it? Is that it? I think that's it. It's pretty close. So let's put it down here. It's different. It's totally different. It's the one right under it. Okay. There. I was picky. So, okay, now we got the cash outflows. Cash outflow. And this is going to be like expenses. And there might be some deviations from traditional expenses, but we're going to say expenses. Outflows. If I misspell something, I apologize. Inflows. So then we're just going to pick up our expenses. So the first one is the rent. Now when we pick up, I'm just going to pick these up as they appear here. You might say, well, what order should this be in? Because you're going to have a whole long list of expenses. Well, if you were using accounting software, for example, it would just pick up all the expenses in order by your alphabetical order of the account names, unless you tell it otherwise with things like sub-accounts or account numbers. I'm not going to get into account numbers here, but if you're just compiling it yourself, then you're typically going to want possibly to put the larger numbers on top, and that'll give you some, because they're the more relevant numbers basically up top, like the rent's probably the first one would be quite common. And then you also might have some subcategories that you might work into place here with subcategories like restaurants, and then break out your different restaurant categories on down below. So we're just gonna populate these as they show up. They don't necessarily need to be in any particular order. Although, again, if you're compiling it, possibly largest to smallest might be a good convention that's often used. Then we got the spending on food. Notice we're going to have a couple food items here. I'm going to say equals. Pick up the 700 for food. Note that I missed the 700 and I actually picked up the 2100 here. I'm going to go through the whole problem with that 2100 in it, and then we'll kind of explain that adjustment at the end and how that could be fixed basically with a double entry accounting system. These are going to be similar formatted, whereas I'm going to indent these, home tab, alignment, indent. We're going to make these blue, that whatever that blue is, right click. That blue is like this one. That's the one. First time, got it that time. And then we've got the auto insurance here. Note that auto insurance is one of those things that you can pay the auto insurance, for example, not monthly, but yearly, or 6 months or quarterly or something like that. And if you do, say you pay a whole year of auto expense, that's usually when the accrual method kind of comes in useful, because if you were to deduct or have an expense or outflow for a whole year's auto insurance in year 1 or January, and then compare January to February to kind of budget and see how you're doing month over month, that would distort January. It would look bad because you paid February and the rest of the 11 months rent in January. And that's where the accrual ideas come into play, so that you could do that comparison month over month. However, doing an accrual accounting concept would mean you'd have to put an asset on the book, you'd have to do adjusting entries. So there's pros and cons, but you want it when you do your budgeting, you just got to note those kind of things and decide what method you're going to be using. If it's just a monthly method, we should be okay to expense it here, and we're on a cash basis anyways. And then we're going to go to lunches. So notice we got 2 food items. I'm going to break out the lunches, assuming this is like my takeout lunches, possibly for like work lunches or something. Indent that versus maybe groceries up top. And then, and notice these categories are different than business. I might call it all meals and entertainment or something like that. Here I might break it out. We also might want to subcategorize those different food items into, so we can total them up for total food, and also have the detail of the subcategories. Clothing, we got the 140, so we're assuming we spend 140 on clothes most of the time or every month. I don't spend much on clothes every month. I think I just wear the same thing, but we're going to say that we spend on clothes. And then we're going to say that we have the telephone bill, monthly telephone bill, which of course we can simply look up for the telephone bill. And then we've got the loan payment. Now this is a tricky one, because the loan payment, you could think of it as a cash outflow. You'll recall when we looked on the balance sheet that we had something on there, the loan was called like student loans. So if I paid the loan, really what's happening from an accounting transaction standpoint is that you're having an expense. If it was an accrual kind of concept, you would have an expense here, which would be the interest, the cost of the loan, and then the other balance would be decreasing the balance sheet amount on a transaction by transaction basis. So this is kind of a deviation. So we're on a cash basis. We're just going to deduct the whole thing. Notice on a cash basis on the balance sheet, you might not even have, the loan. You might, when you got the loan, if you were completely on a cash basis, when you got the money, if you got a normal loan, you got the money, you might call that a cash inflow, right? If it was a cash flow statement. But of course, we're recording the loan on the books because we want to record the liability, and then normally you're kind of doing an accrual thing at that point. Then you would have to be breaking out every payment, the interest portion versus the loan reduction portion, and so on. So there's a little bit of difference here between the accrual and cash method alignment. I'm going to indent cash flow here, the full payment. And that means, notice that when I record this full payment, that also means that I'm not, as I make payments, my loan balance will not be the same, right? Because now my loan balance would have gone down when I made the payments. So if you're making your financial statements periodically from the loan statement, then you'll be adjusting your loan statement every time you create your financial statements from scratch. As opposed to if you have an accounting system, like a QuickBooks system, where you're recording transaction by transaction, which is the better way to go generally if you can do that, then you're going to have to do more stuff like breaking out the loan payments or doing periodic adjustments with it. So then we're going to say that we have the loan, and then we've got the payments for electricity. Payments for electricity, monthly bill, which of course we can pick up pretty easily. So we're going to say font group, and there we have that. And then we got donations we give to charity quite often, about $260 a month we're saying. So we're going to go ahead and highlight that. And then we've got the restaurant spending. So we'll pick up the restaurant spending. And so this is another food one. So notice we had food, we had lunches, and now restaurant spending. So we're breaking that out in some different formats. I'm going to go ahead and make that this, and that's it, I think. So we got all of them. I won't put a little tick mark, but I think we ticked them all off. And then we're going to go to the home tab, font group, underline. That's going to be the total cash outflows. And that's going to be basically our expenses in essence. And summing that up, trusty sum function. Notice when I use these summing, I'm only summing up one column at a time, meaning I'm not jumping from this column to that column. I'm only summing up this column. Equals the SUM, Shift 9, and then you can select or just highlight that series, which will give us the I6 through I15, and enter. And that'll give us then finally let's do some indentation here. Let's indent this. Alignment, indent. Alignment, indent. Make this one a different blue. And then this is going to be our net. We're going to call it net cash flow, which would in essence be our net income on a cash basis, which is going to be equal to the 4,007 minus the 5,215. Now I think I actually have an error here, and that error looks like it's going to be right here. So I'm going to pick that up. That I picked up the 2,100. I should be picking up the 700. So I'm going to change that to the 700, and that should be it. Now note that error right there, if I was using a double entry accounting system, I'd be able to pick that up. I'd find the error. If I'm just creating this by my records, by just kind of looking at my bills and looking at my information on the balance sheet, then it's more difficult to pick up a data input error like that. So if you're using something like a QuickBooks actually entering the transactions, then you have a check against making errors like that. And if you're just kind of picking these up monthly from your statements, then you don't have that double check of the double entry accounting system to really help you to make sure you don't have just simply a data input error like that. So that's going to be our 700 here. Okay, so now if I go to the bottom, I'm going to make this basically a dark blue. I'm going to go to the Home tab, Font, and I'm going to make this category the dark blue, because that really ties into the balance sheet. So now I'm going to unhide some cells by going to from column B, selecting column B, and I'm going to drag over to H. From B to H, let go, right-click the selected area, unhide. Whoops, I hid. I'm going to do it again. A to I, right-click and unhide. I don't want to hide it. I want to unhide it. I'm going to spell check it, outflows. Let's outflows. Okay. Now notice this bottom line of the balance sheet is that net worth. That net worth, the story of that net worth kind of includes what happened here on the income statement. And to kind of verify that, if you were making your books from scratch or trying to tie these two things together, then you would typically, on a bookkeeping standpoint, have a reconciliation from the prior month to the current month. So in this case, we have the net worth, which would kind of be the equity of the 21,540. If we looked at that net worth last month and looked at our net worth, we're going to say 20,655, and we can tie those two things together with the activity that happened. Now, again, this isn't may not be exactly perfect because of things that would be adjusted with our double entry accounting system, including this loan payment could throw things off between an accrual and cash flow basis and whatnot. But the general idea would then be, well, this is where I was last month. So I'm going to just plug this in here. We're going to say last month we were at, let's say then, we'll call this the beginning net worth. Say debt. And that's going to be equal to this number down here. So net worth last month. And then we're going to say that there was an increase, a net increase that we have, which is kind of like the net income, which would be equal to the 855. Going to underline that, font group and underline. And that's going to give us our ending net worth. I'm just going to call it ending net worth. And that's going to be equal to the sum of those two items, and that's going to be our 21,540. So if we were doing and I can make this entire thing basically blue here, that same blue, because that's tying out our income statement to the balance sheet. So you can see why the income statement is, in essence, you can think of it as basically a breakout detail, an entire statement on the detail of kind of like the equity section, the net worth. Again, it's not perfect here because we could have some deviations that we had once again from the accrual basis, which is our loans and our loan payment, for example, here. But if we were recording this on a transaction by transaction basis using a double entry accounting system, then we'd have to tie that out, right? Those things would tie out depending on how we decided to basically enter the double entry accounting system into something like a QuickBooks. And conceptually, that's what you want to be thinking, right? When no matter how you put these financial statements together, you're basically thinking, okay, this is where my net worth was last time, and now this is my activity that happened this time. So that activity should be the difference in my net worth that happened this time, right? If I'm going from last month to this month, the balance sheet shows me the difference where I am this month at this point in time compared to last month at this point in time. The income statement should show me the detail, what happened during the month to get me from last point to this point, and therefore we should be able to reconcile basically last month to this month using the activity from last month. Beginning balance of last month, right? Beginning balance of last month plus the activity should give us to the ending balance on the current month. And if you're using accounting software like QuickBooks or something like that and entering these transactions period by period, it'll force you to kind of be in balance, and you'll be able to see that clearly, and you get that double check with the double entry accounting system. If you're budgeting just kind of periodically, meaning you can possibly, and you can use other software to help you with this, basically put together your balance sheet periodically from your statements, from your bank statements and whatnot, just as of the end of the time period, and then kind of compile your income statement using the ending balance statements that you have and estimate it, then you're not really using that same double entry accounting system in the same way. You can do it, but it's going to, you're just kind of compiling things together that way instead of recording them kind of as they happen. So it depends on what method you're going to use and how concise that tying out will be. And that's a personal choice that you can use. There's not a right or wrong way, but just keep in mind that these two things should, in essence, tie together. This income statement should give you the activity that shows you the change from prior period to the current period of the balance sheet, which should indicate where you stand.